In this video, we'll be discussing the ins and outs of taxes when it comes to investing in dividend stocks. Receiving dividends in your brokerage account feels great, but it is by no means free money. First of all, these dividends come out of a company's earnings, and more importantly for this video, they are considered income for you, so you must pay taxes on them. There is, however, a way to not owe any taxes on dividends that we'll discuss later in the video. The amount you pay in taxes on dividends primarily depends on whether the dividend is qualified or non-qualified, and then it also depends on how much income you have for that year. So first, let's talk about qualified versus non-qualified dividends. A qualified dividend is one that is paid by a US company or a foreign company that is listed on a US stock exchange. So for example, some foreign companies like Alibaba or Jumia are actually, foreign companies, but they are listed on the New York Stock Exchange, and if they did pay dividends, then those could potentially be qualified. The other criteria that must be met for a dividend to be qualified is that you must own it for more than 60 days within the 121-day holding period surrounding the time of the dividend payment. This means you can't buy the stock right before the ex-dividend date and then sell it right after the ex-dividend date, and in that case your dividend would be non-qualified, which would have less preferential tax treatment. So starting 60 days before the ex-dividend date and ending 60 days after the ex-dividend date, you must own the stock for a total of 61 days or more during that time period in order for the dividend to be qualified. The one final criteria for a dividend to be qualified is that the shares must be unhedged during the 121-day holding period associated with the dividend. This means that there can't be any puts, calls, or short sales associated with the shares during that 121-day period. Any dividends you receive that don't meet the aforementioned criteria will be a non-qualified dividend and will be taxed at higher rates. Additionally, REIT dividends are always classified as non-qualified dividends regardless of your holding period because REITs are required to pay out 90% of their earnings to shareholders as dividends. So now let's talk the actual tax rates. This table right here shows the income tax rates on qualified dividends based on your adjusted gross income for that year. Currently, we can see that if you make less than $41,675 as a single person, you will pay 0% on dividends. The next bracket is a 15% tax bracket, but that goes all the way up to $459,750 of adjusted gross income. So the vast majority of people will probably be paying a 15% tax on their qualified dividends. And finally, even if you do earn more than $459,750, you only pay 20% on qualified dividends, which is the maximum rate for qualified dividends. Now looking here at the table for non-qualified dividends, we can see how unfavorable these rates are compared to the qualified dividends. As a single person, you pay 10% on dividends even if you have no other taxable income that gets you to $10,275. After which you pay 12% on non-qualified dividends, and at $41,775, the rate goes up to 22% for non-qualified dividends, which is already higher than the maximum rate for qualified dividends. And the maximum rate for non-qualified dividends is a whopping 37%, which is almost double the maximum rate for qualified dividends. There is also one final tax you might have to pay on dividends. If you do make over $200,000 as an individual or $250,000 as a married couple, you will likely be subject to a tax called net investment income tax, which is an additional 3.8% tax levied on any investment income, which does include dividends. So true dividend tax rates would max out at 23.8% for qualified dividends and 40.8% for non-qualified dividends. Let's walk through an example now. Let's say you are a single person that makes $100,000 in a year from your job, and that's your adjusted gross income. And let's say you also earn $10,000 in qualified dividends. As we saw from the table, you'll be in the 15% tax bracket for those dividends, which means you'll pay $1,500 in taxes on your dividends. However, if that $10,000 was instead earned from non-qualified dividends, you would be in the 24% tax bracket and would pay $2,400 in taxes on your dividends, which is a full $900 or 60% more. The advantages of qualified dividends look very enticing when we talk about married couples, because as we can see from the table, you can make up to $83,350 before paying any taxes on dividends if you're a married couple filing jointly, which is honestly pretty awesome. Now, there are some exceptions to this whole paying taxes on dividends thing, and that comes in the form of tax-advantaged accounts. In some tax-advantaged accounts, such as the Roth IRA, Roth 401k, HSA, or 529 plans, all income or earnings from your investments in these accounts is tax-free, which does include dividends. It is important to note that in most of these accounts, except for the HSA, contributions to the account are already taxed, so you aren't completely escaping Uncle Sam. For example, you pay taxes on contributions to a Roth IRA and aren't taxed on the earnings, whereas for a traditional IRA, you don't pay taxes on the contributions, but then you are taxed on the earnings down the road. This part of the picture is really beyond the scope of the video as it evolves into a much bigger discussion about retirement accounts and taxes as a whole, but the important takeaway here is that there are ways to earn much more than $83,350 tax-free as a married couple filing jointly utilizing a tax advantage account such as a Roth IRA or HSA. As I mentioned before, if the stock you own has any hedges or options on it, then the dividend counts as non-qualified, so holding dividend stocks in a Roth IRA and then selling covered calls on them can be a great way to minimize taxes and generate even more income. So far, everything in this video has been focused on individual stocks, and investing in ETFs is also a great way to invest for a lot of people because it's a little bit more simplistic and passive sometimes, but the taxes on those dividends can be a bit more complicated because some of the dividends that the ETF receives might be qualified and some of the dividends might be non-qualified. I won't go any further down the rabbit hole of dividend taxes on ETFs in this video, but if you do want me to make a video on that subject in the future, definitely let me know in the comments down below. Certainly no one likes paying taxes, but it does have to be done. The good news is that there are easy ways to minimize the amount of taxes you pay on dividends, as we talked about in this video. If you do have any questions, comments, or concerns, I would love to hear what you have to say in the comments down below. And if you are interested in hearing more about dividend stocks and dividend investing in general, make sure to subscribe to the channel so you don't miss out on any future videos. I'm certainly no tax expert or licensed professional, so if you are unsure about how dividends will affect your tax bill, definitely do your own research on taxes and maybe consult a licensed professional of some sort. Thanks for watching, and I'll see you all in the next one.